So what we did was took a whole bunch of financial content, many hours of it. We sliced it down to the best parts, and a lot of what was left over was related to China. And the thing is that there's so much going on with China right now. It's collapsing from 5 different aspects all at once. So I wanted to show you some of the comments that are going to really help you understand what's going on. And always keep in mind, try to keep it from the perspective of how it's going to eventually affect America, because it will. As I told you it would, it's going to come here next. So much of the world grew as China grew. Now as China is slowing down, turning the corner, it's actually going to be a drag on other countries. We're not buying much from China anymore. It's all playing out now. You'll see in this video, I've got all the best clips in here. Most about China that you need to see, a little bit about Germany. We've got a few other things. Let's get into it. And by the way, the best comment from beneath this video, we're going to talk about it in an upcoming video.
China's economic outlook is simply just not good.
You know that the information out of China these past few weeks through July and August and into September has just been atrocious.
This is really the big concern throughout all of the kind of crackdown, is whether or not we're going to see social unrest and financial instability.
Welcome to the channel. My name is Peter Leeds, and we're all about getting you profits quickly and easily.
Peter Leeds, Premium Investor Enlightenment.
If we start seeing problems in China's banks, if there are concerns about a Lehman moment for China, what we could see is a global risk-off moment for financial markets. It wouldn't just be Australia and Chile and the other commodity producers that would be suffering. It would be the big financial centers here in the United States, in London and elsewhere.
Dozens of private developers have since collapsed, raising not only questions about the future of the property market in China, but about the health of the entire economy. The latest to struggle, Country Garden, was once the country's largest developer by sales, and a company many saw as too big to fail.
Country Garden, obviously the latest poster child of the property sector woes.
The fallen fortunes of Country Garden you can basically see in a 10-year chart.
It feels like we're looking at a broad-scale societal and economic and political breakdown, and we are.
A non-significant probability that this ends in a full-scale crisis.
When Lehman Brothers collapsed in 2008, it marked the beginning of a global financial crisis.
We've had a historic day on Wall Street. Lehman Brothers, the 158-year-old firm, filed for Chapter 11 protection in U.S. bankruptcy court today.
If China's economy stumbles, the global implications will be far-reaching, touching anyone who's benefited from having the country as a supplier or as an end consumer.
Germany's economic hardship is not a secret, and as winter is just a couple of months away, the biggest economy in Europe and once the fourth largest economy in the world will find it increasingly difficult to sustain itself.
Homebuyers are afraid of not getting the home that they paid for.
The problems China have now are deep-seated structural ones.
I think the consensus is already that for China, the property sales may not go back to yesterday.
China's property market is in a bunch of trouble. And because property is the single biggest contributor to China's GDP, when the property sector is in trouble, the rest of the economy is in trouble as well.
Everybody expects the government is going to do something in the not too distant future because it keeps telling us it will. They keep talking about the fact that they want to strengthen domestic demand and, quote, strengthen consumption. But time after time, they fail to take the measures that actually will do that.
It's more detrimental to sentiment because it's telling you that something's fundamentally wrong with China's housing market that's pushing even formerly healthy developers to the brink of collapse.
Because of the overall economic slowdown, businesses don't want to hire as many people, especially not young people, because you have to train them and you don't know if they'll stay around. You don't even know if your business is going to be around.
80% of the wealth of the average Chinese household is tied up in their homes. When that home price goes down, they feel poor, they spend less, and that has been a real drag on the economy this year.
So when we were all able to congregate again and mix freely and travel by train and bus and aeroplane and what have you, it did unleash this kind of revenge consumption, really, which was to make up for lost ground.
You look at their import numbers, you look at their export numbers, all again, red negative. And we invest in other parts of Asia, Australia, South Korea, Japan. But at this point, I think it's prudent for folks like us and your viewers to start to rethink how they're going to deploy capital in China.
Now, while the UK is struggling to get inflation under control, China's economy is suffering from the opposite, deflation. Consumer prices declined in July for the first time in more than 2 years. People and businesses are not spending, and the world's second largest economy is struggling to revive demand.
How did the world's second largest economy end up here?
the post-COVID recovery has been weaker in China than in many other countries. No question about that.
The second largest economy in the world is in trouble. China is facing a growing list of problems: real estate, semiconductor bans, and labor market gyrations. The world's second most populous country also has a major youth unemployment problem. China's youth employment rate now ranks with several G7 countries that have notorious problems with getting younger workers into the labor market, like Spain and Italy. India, the world's most populated country, has also been dealing with a youth employment problem.
And then what happens in China was in the last 10, 15 years, the housing market skyrocketed. And then the value of the, say, second, first-tier cities property, especially first-tier city, my experience researching mostly in Shanghai, it went 6-fold, 10-fold, right? That's how people are sitting on this wealth.
China's economy, along with other parts of the world, is struggling to find growth. A lot of Chinese wealth is tied to real estate. And as the housing sector grew and grew in the late 20th and early 21st centuries, homeowners saw a big increase in their net worth. That all reversed during China's zero-COVID policy. Investment in real estate began to plummet from 8.3% year-over-year growth in 2018 to a sharp decline of 8.4% in 2022. Policies from Beijing forced property developers like Evergrande to default on their debts and eventually file for bankruptcy. Shares of Guangdong-based Evergrande began trading again on August 28th after a 17-month halt. The stock plummeted 78% in the day. Even imports and exports to and from the country are down in most sectors, including a 23% drop in exports to the United States and a 21% drop in exports to the European Union in July compared to last year, all while imports of crude oil dropped 21% in July from a year ago. Just year to date, the country's imports have fallen 7.6% from last year.
Just by putting more money into AI, it has the potential to replace even more workers, especially young workers, in the near future. So it's not necessarily good for job creation, but it's very important for China's long-term growth.
Most developed countries saw a boom in consumer spending after pandemic restrictions ended. The huge increase in demand for goods that were limited in supply, coupled with rising energy costs after Russia's invasion of Ukraine, actually inflated prices, but that has not happened in China.
Some of the problems in China may be deflationary, but if China is experiencing deflation, that doesn't change the fact that consumers aren't really spending. Consumers aren't spending in China, and they're not spending abroad either.
In the early 2000s, there was an enormous construction boom here. Skyscrapers, apartment complexes, they were going up everywhere. There was this fundamental belief that property prices could only go up. That belief has been shaken tremendously, and when you speak to people now, there's a real worry that maybe what follows a boom is bust.
Germany plans to cut reliance on China in critical sectors, including medicine, lithium batteries used in electric vehicles, and elements essential to chip making.
The privatization of property that began in the 1990s created one of the largest explosions of wealth in the country's history.
China was urbanizing, with tens of millions moving from the countryside to the city, and China was getting richer. All of these things together would already have driven an enormous boom in China's real estate.
Officially, Germany entered a recession in April, so its economy has been in a recession for 3 consecutive quarters now. As its manufacturing continues to decline and the largest producers move their factories overseas, it's becoming increasingly obvious that a quick recovery or a recovery at all is likely not in the near future.
In comes Xi Jinping. In the beginning of his second term as China's leader in 2017, he really starts putting his shoulder into this mantra that homes are for living in, not for speculating on. China's efforts to tighten regulation over its developers culminated in the unveiling of what's become known as the 3 Red Lines policy in 2020. It greatly limited the ability of those firms to get financing. A lot of smaller companies ran into trouble almost immediately. Then Evergrande, once the country's biggest developer, warned of a potential cash crunch. A year later, it was in default, sending shockwaves through global markets.
Germany imports more from China than from any other country in the world. As you can see here, these imports significantly exceed imports from any other country.
The day has finally come, Sherry. We've been circling around this, what has very, very recently felt like a complete inevitability, right? But Evergrande now declaring officially in default.
Consumer spending is down, lending is down, which should never happen in a country that is just capitally driven. The Chinese basically force-feed capital into everything, and so lending should always be going up, and it's not.
Problems at Evergrande were well recognized. Hedge funds had been shorting the stock for years. The surprise, though, was the shift in government policy, from standing behind the debts of big property developers to allowing them to go under.
Cutting off your biggest trading partner is an aggressive move, for a country with a rapidly declining economy. Its stagnation is so deep that the International Monetary Fund predicted that Germany would be the worst performing major economy this year. Its growth expectations are virtually at 0%, I believe it is 0.3%, which is not much better than the growth expectations for the EU as a whole.
This trend of friendshoring has clearly picked up. You have many economies around the world that are benefiting from the fact that American companies or even European companies still want to offshore. They just don't want to do it to China anymore. So you've got economies in Southeast Asia, from Vietnam to Indonesia, countries like India, closer to America, such as Mexico, even in Europe, economies such as Poland.
But the problem is that you're just delaying, postponing the problems, but you are not solving the problem. You are getting more and more degrees that don't really give you any return.
More than 1 in 5 are now officially unemployed, dashing their hopes for a better life.
The most recent full data to be released by the Chinese in the last 2-3 months tell us that the birth rate has dropped in China by nearly 70% since 2017. That's the fastest drop in the historical record, not of China, of humanity throughout all of recorded history.
Please subscribe to the Peter Leeds channel. We're all about getting you profits quickly and easily.